Southeast Asia's largest lender is spending billions of dollars to pursue a technological transformation. CEO Piyush Gupta says going digital has already paid off.
We're beginning to see impact on our revenue lines. Our bank assurance business, for example, our mortgage business in Singapore, for example, our business on wealth, for example, all of them are seeing important increases in revenue, partly attributable to the fact that we have digitized the way customers engage with us. We are also seeing important improvements on the expense side, and that's because our cost of customer acquisition is lower when we do it digitally, as well as our transaction processing costs are lower because we kill the paper, so it just goes straight through. The improvement in our cost-income ratios from 45-46% a couple of years ago to 43% now are testament to the improvement in both the income line and the cost line. Outside of that, the other place we see benefit is the ability to realistically look at expanding into markets like India and Indonesia at some scale. Ex-digital, we were finding it very hard to envisage an expansion into those markets because the brick and mortar strategy is very hard to make work.
You were the first one to identify Alibaba as a potential competitor for the lenders in Singapore. With your digital transformation, are you ready, are you prepared to face Alibaba, Tencent, head on?
I think we've made important improvements. Our technology is beginning to slowly resemble theirs a lot more. We are a little more nimble, our culture is becoming a little more startup-like. But I have to say, they're still very formidable competitors. One of the advantages they have, in fact, any of the half a dozen platform companies in the world have, is that the cost of customer acquisition is very low, because they're already sitting on a massive pool of hundreds of millions of customers who they can cross-sell into financial products very, very quickly. That's different from the 99% of fintechs who are small, but who have to spend a lot of money finding customers. That's not true for Alibaba or Alipay. They have that.
So what now? The MES has said it's prepared to ease regulations to allow banks here to acquire digital platforms. Is that enough? Will that level the playing field?
The way to run a bank is to make the bank invisible. I say that the long-term view for DBS to make DBS invisible. And what does that mean? That means that people really don't want to do banking as an end in itself. People want to do something else with their lives. They want to buy a house, they want to buy a car, they want to go on a holiday. The banking activity should be seamlessly and invisibly hidden in something else that you want to do. If we can work with partners where we can hide the banking service in something else that the partner provides, that would be a big step in the direction we want to go towards. And so the new rules from MES are encouraging in that standpoint.
Are you in talks to acquire any digital platforms?
Well, we've been in conversations all the time to look for partnerships. If you look at Digibank in India, 1/3 of our customer acquisition comes through channel partners and not directly. And that's a big difference in our philosophy and approach. Banks, including DBS, used to earlier be what I call pipeline companies. So there's a straight pipe from the bank to the customer. Today, we're increasingly trying to be platform companies so that we can engage in an ecosystem of relationships and bring customers in through channel partners, credit underwrite through channel partners, and use channel partners to improve our range of product offerings.